John Taylor of Liberty Corporate Benefits. Welcome again to Living Markets with Liberty. How are you, John?
I'm good, and yourself, Leon?
I'm very well, thank you. So last time in our second episode, I tongue-in-cheek made reference to the boring advice that you gave us. And believe it or not, it's one of the highest viewed videos on our platform ever. So I'm having to re-question so many things that I've always believed. John, since we had that discussion, the markets have continued to go up another 3% or so this month. It seems to be never ending. So before I had this call, I thought to myself, right, please, John, don't hit us with anything earth-shattering because everyone seems to like boring. But I suspect the advice is going to be the same. So I thought, I'm not going to listen to John anymore. I'm going to go ask somebody who knows everything. So I went to Elon Musk Grok. And Elon Musk Grok is telling me the following, and let me read it out to you. This is with regards to current valuation levels of the JSE All-Share Index. So, as of September 26th this year, the All-Share Index, which tracks approximately 99% of the total market capitalization of the JSE, closed at about 106,700 points. This reflects a year-to-date gain of approximately 22% from the same period last year, driven by strong performance in sectors like mining, finance, and consumer goods amid an economic recovery. That's interesting. And global commodity demand, which we all know about. However, the index has been volatile of late, blah, blah, blah. Key valuation metrics. The Aussie's valuation remains modestly attractive, but leaning towards fair value, based on standard multiples like price to earnings ratio. Here's a breakdown. Using a trailing PE ratio. Currently, it's about 13.45 as of mid-September, calculated using the index's current price divided by the last 12 months worth of earnings per share. So now if you compare that to historical average over 10 years, the 12.16 versus that 13.45, over 20 years, 11.83 versus the 13.45, and over the last 3 years, 12.45. So without reading through all of this, effectively what it's saying is an historical earnings can be a bit dicey, I suppose. But what it is saying is that ultimately we're within one standard deviation of the more recent average. So given that, we're a little bit expensive, but not massively so. If you look at it over the longer period, the 20-year sort of scenario, it's starting to look a bit toppish in that regard. What is Grok's advice? It's the same as yours. Stick to your knitting. Right? I was so disappointed. I was saying, come on, tell me something else. Stick to your knitting, stick to your plan, no knee-jerk reactions. Is that still your advice?
Leon, I'm going to not disappoint you, and I'll say yes, it hasn't changed. I think what is pleasing, and it bears out in what you've read out that Grok has given some light on, is that the call it almost extreme cheapness that the JSE has had for quite a period of time. That is dissipating. It doesn't mean that the JSE is expensive. And remember, this is also a relative game. Money has to go somewhere. And it still is cheap relative to the US, even though you've seen this continued dollar weakness, which has persisted again into September.
I think that's so important. It's important that our viewers understand that. So at the end of the day, we're all competing for capital flows.
Yep.
Now, if interest rates are coming down, that means your return on cash or bonds is less. So equities becomes more attractive in that regard. When looking at placing the money in equities, if you look across emerging markets and you compare our valuations relative to other emerging markets, it's all within a similar range, if not we're slightly cheaper. When you compare us relative to developed markets, we're quite a bit cheaper in that regard. So there's positive news to favor developing markets like South Africa, and also with the geopolitical situation and uncertainty, a lot of our commodities people seek some kind of safety or certainty in that regard. So generally you can find the positive, but are you starting to feel at all nervous?
I think, Leon, when you're looking after other people's money, you always feel a bit nervous. I'm not worried necessarily about valuations or even necessarily on the economic outlook. I think that a part of this run in the local markets, yes, it's got a lot to do with the commodity cycle. It's got a lot to do with kind of global GDP growth. But I do have that kind of inkling that there is a semblance that says that some of the economic wilderness that South Africa has been in, we might just be dissipating a little bit. I wouldn't by any means say, it's all out of the woods, but it certainly does feel as though there's some space to believe in the SA Inc. story, and more longer term, not just based on recent news flow. Um, that being said, I think we must always be cautious when markets have run up by 20-25% over the course of 1 year. And that's now baked into some 3 and 5 year numbers that are also in the high teens and low 20% per annum. So I think, are all enjoying, from a pension fund's perspective, a market where all asset classes, bonds included, have had decent runs well above inflation in rand terms for the last 3 or 4 years. And if you compare that to what we were dealing with just before the COVID pandemic, where there was anemic returns out of the JSE, our bond returns actually were ahead of that, and that was largely credit risk that everyone was worried about. It is a more positive outlook that we have today than 5 or 7 years ago.
So just before we get on to talking more about the markets and actions that call it trustees or investors should be taking or should have taken already, I find it interesting right now, the access to information. So exactly this exercise that I just did asking Grok. And Grok hasn't spat out rubbish. I mean, it ultimately garnered that from 18 different websites, including Financial Times, JSE, Bloomberg's, and so on, all within less than a minute. Just a simple prompt to do that. So the tools to educate ourselves and to gain access to information are so evident. And we have our EBnet Evolutionaries conference coming up next week, which is a fully virtual conference. It's on your PC. You can pop in anytime during the week, come and go as you like. You don't have to sit through talks. You can go and choose what you want to watch, and consume as you feel free. And the theme of the conference is AI and tech in the investment, savings, and retirement industry. And I interviewed a few people with regards to AI and investment management and the impact that that's ultimately have. So even professional investment managers are more and more adopting AI to be able to search further and to search deeper than what they ever did before. And the one example that was given to me was that, and you should go watch this interview at the conference with Differential Capital, was that they are able to get customer feedback through different sites and so on, that when they go sit down with management of companies, they can then say to them, are you aware that in your store in Uppington, there's been a certain level of unhappiness, blah, 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 to get a feel for how in touch management is in that regard, kind of thing. So how, in your capacity as an investment consultant to pension funds and so on, what is your view around AI and the adoption thereof when you're doing your due diligences with asset managers? Or has it not yet gotten to the point where it's deemed as being almost a must-have?
Leon, yeah, it's accelerated over the last year. If I think back, kind of it, since AI as a term has gained traction, and remembering that we've had some semblance of this kind of machine learning as well, and the like for some time, the original kind of uses that we found for it In our space, we're in analyzing things like central bank speeches and the like to look for guidance on kind of where they're looking in terms of interest rate movements, inflation outlooks, growth outlooks, and the like. You could apply the same with the IMF. World Economic Outlook updates, as quarterly economic outlooks. And that already kind of just used word clouds and the like to try and pull out sentiment, call it, and try and apply a number to sentiment. That's gone another level further, where we're able to use and are using machine learning in contexts of understanding if managers are sticking to their previous philosophies in the face of similar market conditions to the past. Are they pulling the same levers? Are they behaving the same way? And that links back from a asset consulting angle back to those 4Ps, which remain the 4Ps. It's performance, it's people, it's process, it's philosophy. And performance is one thing. It's easy to ask it to analyze performance and give you a view of those kind of risk and return metrics. But it's another thing, and becoming increasingly good at understanding philosophy, changes in philosophy. People, obviously, you can monitor through there as well. And then, of course, processes and understanding. If I'm expecting manager A to perform in a certain way under these conditions, has something changed? Is something broken? And we were able to highlight to clients in just 18 months ago and say, this manager actually outperformed what we would have expected in these conditions, and we want to dig a bit further. And the client said, why are you kicking the tires on something that's doing well? And we said, because we don't know what's going to happen if it goes the other way. So that's ways in which AI is completely changing the game for us. It's not just a matter of the fact we can do ALM models and kind of mean variance kind of optimizations on portfolios more quickly. I mean, that's obvious that PCs can do that, and AI is helping us do that. But to the extent that it can help us analyze data and pick out worrying trends or trends that we weren't seeing, that's changing the game.
I always find it interesting that, like our JSE, in terms of the number of listed stocks, has dropped from 1,000, whatever it was back in the 90s, down to just over 300 or so now. Yet the number of available unit trusts is multiples of that. It's in the thousands in South Africa. Yeah. So the job of a financial advisor to advise their customer on what unit trust to invest in is actually more difficult these days than investing in the stock market itself. And I do think that, obviously been the advent of DFMs, which has been a necessity because of that plethora of choice. But also, I think now AI will play a role significantly, not just in building financial plans, but in helping filter what investment choices individuals should be considering as well. I don't think we're quite there yet.
Yeah.
But I think it's quite obvious that the AI will be a reliable partner. Yeah. In that respect. So it'll be interesting to see where that goes. And I also asked the question because I'm overweight tech. And I'm overweight tech because I can see, despite the valuations, that this AI revolution that we're going through, or that we've just started, is to stay, and it will continue for quite some time. But I think with good reason. And that's just my personal sort of analysis of it. I wouldn't recommend to anyone that they pile into tech at this point in time. But it's just interesting to see how we each view things differently based on our own experiences, based on our own risk tolerances, and so on. So let's bring it back to a pension fund. You've said boringly that pension funds should stick to their knitting. They should diversify. Now, when it comes to diversification, that means across asset classes, it means across asset managers. It's also across different ways of investing.
Yep.
So one of those ways of investing could be private markets versus the traditional public markets or listed markets. It could also be hedge funds. Now, hedge funds is an interesting one because hedge funds seem to have picked up a very bad name for a couple of reasons, and aren't often used to any great degree in a pension fund setup.
Yeah.
Yet when you have a look at some of the better call it long-only fund managers or up-and-coming rising fund management companies in South Africa, the 361s, the truffles, the all weathers, and I can keep going with the list. A lot of them have roots in hedge fund management. Now, surely when markets start getting a bit heavy and you're a bit uncertain, to have the ability to manage the beta, to take out the market risk through hedge fund management, it would be a great diversifying tool for a pension fund. So if you agree with that, so first of all, do you? Why is it just not being utilized more? And is that a fault that we have in the industry?
Hedge funds, you're right. I think that they have developed unfairly a reputation that they're quite aggressive, that they are contrarian, that they tend to be a bit dangerous in some ways for pension funds to look at. And the reality is, like anything, it depends on how it's being used and how it's being run. Part of that challenge, I think, comes from just the sheer complexity that the outside world looks in on pension or on hedge funds with, and battling to understand how is it possible that they can sort of manufacture these returns from within these wrappers that they work within. To some extent, I think people can make the leap from public listed markets into private markets more easily than they can necessarily then take another step further and say it's a hedge fund. Because it combines elements of derivative type management, it combines elements of private fund management. So I think they are a valuable tool, and you're absolutely right. Some of the kind of star managers that we see in rising in the call it traditional asset management sector have roots in the hedge fund sector. And there's no doubt about that. And that's not just true in South Africa. I mean, you've seen that in other parts of the world too. I think it probably is a matter of making the actual mechanics of these a lot more understandable, demystifying them a little bit. And then also keep in mind, again, hedge funds are competing for capital with other asset classes. If vanilla asset classes deliver the kinds of returns that we're seeing, and people aren't necessarily cognizant of the risks, you're going to find very little governance budget, very little time and effort spent on understanding hedge funds because, to the average trustee, it feels like a fringe asset class. It's only when the real benefits of those are highlighted and brought forward that you might find more boards looking to invest deeper into them.
EBnet is proud to bring you top quality content from experts across the financial services industry in South Africa and internationally for free. Your support helps us in doing this. All we ask is that you subscribe to our channels by clicking the subscribe button below. Share this video with others you think will benefit from it, and give us thumbs up if you are enjoying the content. That way, you help us help you. Thank you from the team at EBnet. For more great content, please visit www.ebnet.co.za.
So I want to challenge the industry a little bit around hedge funds, and I'm no hedge fund sort of cheerleader, but what I do find is that, firstly, on the negative side, the high fees that are associated with them has turned people off, and I get that, I understand that. There's also been various scandals around the world, frauds that have taken place in that space, but that happens anywhere, in any type of specifically investment management approach and so on. To me, what I find interesting when it comes to hedge funds is that if you're a long only manager, you sort of look at the shares, you filter them out, and you say which ones are the ones that suit my approach that I can buy. And then you research those in greater detail, make your choice, cognizant of your benchmark. So the amount of actual research you're doing of any great degree is X%, whatever that might be. When you're also selling shares, it means every share is fair game. So you're doing a lot more research into the available market set. Now, in South Africa, with a small available market set, I sometimes wonder why we pay active fees. Because there's the amount of work involved is way less than what it would be globally. And I'm looking at this from a South African versus global perspective. Obviously, the market's globalized, so the guys are doing a lot more.
Yeah.
But that benefit of looking at shares both in terms of the good and the bad, and making an active decision to actually sell the ones that are bad, in your opinion, you have to have a high level of confidence and knowledge and rigor
Yes.
in your approach. Now, to me, that's why I think some of these up and coming fund managers with that grounding are doing exceptionally well. But also, the from a diversification perspective for a pension fund, I think it's exactly what pension funds enjoy when they get nervous. And that's why I asked you the question earlier, are you starting to feel nervous? To me, a hedge fund just gives you, it sounds counterintuitive given what the market thinks, but it's actually the risk mitigator for the investor psychology.
Yeah.
And that's what I think is somehow missing in the thinking from an investment advisory perspective.
Agreed, Leon. I think we, to a large extent, we've forgotten why they're called hedge funds. It's exactly to hedge out that kind of market risk. And to your point, there are different type of hedge funds who are hedging different of these risks. I mean, the long only ones is one example, long short arbitrage type ones. They're various structures, and I think again, pension funds can look to get their feet wet, start very vanilla, start on the very basic kind of structures, and you can work your way to understand what is possible in this space.
So let's then just quickly talk about interest rates. So the Reserve Bank kept interest rates as they were this month, much to many people's dismay. Where do you think things are headed in that regard, and why?
Yeah, so I was one of them who was a bit taken by surprise. I honestly thought when the US cut rates the night before, that the Reserve Bank would act, especially given that inflation numbers for August came through at towards the 3.3%, I think it was, which I get is above 3.0, and they seem to be very, very fixed now on 3.0. I do have a feeling, as much as the Reserve Bank governor and the Monetary Policy Committee says they're not led by the US, I think with the expectation the US will continue to cut rates, they should be forced into a space that they're going to, especially if inflation does moderate from the 3.3. So yeah, as I said, a bit disappointing for me. I do understand their thesis and why they are angling at a lower inflation regime, and there certainly are arguments for that. But I do think that we are hurting the South African consumer in the short term, quite a bit more than I'd like necessarily. But yeah, I think we missed an opportunity there to a large extent. And I guess the one benefit that might flow out of it is some continued portfolio flows, because you've got that differential in rates between South Africa and the US, which has increased. So that's one plus, but it's not like we're battling with rand weakness versus the dollar at the moment anyway. So yeah, a bit of a bitter pill for me last week.
So the one thing I always felt I could sort of set my clock by was that the rand would depreciate. And now that's being destroyed in my head because the rand's been so strong recently relative to the dollar. So what is causing that rand strength? Is it rand strength, or is it dollar weakness that's coming through?
Leon, you can continue to set your watch by rand weakness. As long as our inflation rates remain higher than our trading partners, you're going to see that happen. That's just purchasing power parity. Now, it's a bit like that whole thing about the person with the dog and the the dog is running around and the person's in the middle. Exchange rates can be a bit like the dog. In front of you, behind you, left of you, right of you. But as an economy, as kind of the person walking the dog, you're going to broadly follow in the direction that the dog is going. So I think it's, with that being said, it isn't rand strength. It's dollar weakness. If you look at how the dollar's behaved against the pound and the euro, you'll see it even more strongly there. And the other evidence point is the rand exchange rate with the euro and the pound hasn't moved materially. In fact, it has weakened. The rand is weakened relative to those two currency pairs. So Yeah, I think we must be careful to only look one way on these exchange rates. In the past, it was always easy to because you assume the dollar was going to be strong, but that assumption is faulty at the moment. And part of that also explains why your commodities have run hard. Yes, they've run hard, absolutely, but again, take it back to the fact that if the dollar is weaker and gold is still the same, then in theory, the gold price in dollars is going to be higher. So I think people must keep that in mind. But by no means am I saying that the gold price has remained stable. The gold price has run really hard, as have a lot of commodities, both industrial and precious metals. So, yeah, just be careful around those assumptions that the dollar remains at the same level. And I guess that then points to my next concern is at some stage the dollar is going to strengthen. And that might be because of changes in the US itself, or it could just be because of global concerns. And we still live in a strange world where even if the US looks like it's in trouble for whatever reason, the dollar will strengthen. It's not like the rand. The dollar strengthens in the face of adversity, and I think we just need to be aware that we can't bank on dollar weakness forever either.
So if I'm correct, if I'm remembering correctly, I saw some good stats coming through in terms of economic growth in the US,
Yeah.
which makes it look like the tariffs are actually paying off for Trump. So it'll be interesting to see where that ultimately ends up as well. But there's what's the right word? Some optimism that I'm seeing coming through in that respect, and I'm sure
In the
we'll
US
hear more
numbers.
from Trump about it. Yeah.
And perhaps, Leon, on top of that, remember a weaker dollar does the exact same effect as a tariff on goods important to the US, because importing into the US now is more expensive for an American because their currency is weaker, and exporting is cheaper to other countries. So the exporters in the US are smiling every day.
So we've spoken before about investor psychology, and I just wanted to share this because we are all human at the end of the day, and it doesn't matter how much we engage with all of this information, whatever, we are human. So I've mentioned to you before that I use an easy equities account for my investing, and our editor Natalie opened up her account and she started investing, and I think it's in some ETFs or whatever. I think both of us check our accounts every single day. Now, I'm not certain whether it's to check our returns or just to make sure that the money's still there. I'm not certain which it is, but it's almost impossible not to check. And that is got to be the worst possible thing that we all ultimately experience. So I think the where I want to close off today is just to say to our viewers that you and I can talk about all the greatest sense in the world, and we can share as much as we can, but it's never going to stop people from feeling uncertain
Yep.
or wanting to know more or wanting to go get what might be better. And therefore, your good old boring advice is indeed the best advice, as boring as it might ultimately sound. So
Indeed.
because of that, next time I'm not going to ask you for boring advice. Next time I'm going to probe you a bit on the asset management community in South Africa. I'd like to talk to you a bit about how you're seeing that developing, the different players in the market, the concentration in the market, and just change it up a little bit to delve a little bit deeper into our overall community and investment markets. You happy with that?
I look forward to that. Thanks, Leon.
Okay, good. John, thank you so much for your time again today, and to Liberty Corporate Benefits for their sponsorship of this series. I look forward to chatting again next month.
Awesome. Thanks so much, Leon.
All the best. Cheers, then.
At Liberty Corporate Benefits, we believe that better benefits are better for business. That's why our holistic employee benefits give your employees financial security and lifestyle stability, freeing them up to be their best selves at work. With satisfied, engaged employees, productivity shoots up, workplace errors and loss decrease, absenteeism and presenteeism are reduced, and you attract and retain the best and brightest talent. After all, if you take care of your people, they'll take care of your business. Our brilliant basics are the non-negotiables that explain why more companies choose us than any other for employee benefits. Our employee benefits are easy and flexible, personal and relevant, and resource-backed, with investment solutions designed to help your employees retire comfortably. Comprehensive cover that protects your employees and their families. Financial literacy initiatives to help your employees make the most of their money. And a range of value-added services for holistic care and support. We make it easy to take care of your people and prove that employee benefits can also be employer benefits. Speak to us about getting the benefit advantage. Liberty Corporate Benefits.